Welcome to the Contrarian Investor Podcast. We give voice to those who challenge a prevailing sentiment in global financial markets. This podcast is for informational purposes only. Nothing on this podcast should be taken as investment advice. Guests were not compensated for their appearance, nor do they supply payment in order to appear. Individuals on this podcast may hold positions in the securities that are discussed. Listeners are urged to educate themselves and make their own decisions. This podcast episode may have ads and the occasional announcement. To listen without ads or announcements and take advantage of a host of other benefits, consider becoming a premium subscriber. Visit the website contrarian.supercast.tech. That's TECH for more information. Now, here's your host, Mr. Nathaniel E. Baker.
Barry Knapp of Ironsides Macroeconomics, welcome back to the Contrarian Investor Podcast.
Thank you.
It's great to have you. Very excited. Last year at this time, and this has become a bit of a tradition here, a January tradition, to have Barry, who, by the way, was our first ever guest way back in 2019, to come on and give us his views on me and about markets. And last year at this time, when everybody was bearish, you were a little bit more optimistic, and you got that one right. Credit to you. So we are now, of course, very curious here as we record on January 8th, and the market, which started the year optimistically, has now turned a little bit for the worse. So very curious about your views here on markets, on the economy, and your entire take on this whole thing.
A year ago, you're correct. My bear or bullish outlook really began in October, at the point when I thought we had reached maximum Fed tightening expectations. Very similar. It was similar in many ways to November of 1994 when the Fed did their most aggressive hike of that cycle, the 75 basis point cycle. The market sold off for about 2 more weeks and then found its footing. And even as the Fed continued to tighten a bit, we were through the worst of it and the markets rallied. That analog, along with an improved liquidity environment, our expectation that we wouldn't have recession, were all at the core of why we had an optimistic outlook for at least the first half of last year. And we basically stuck with that view even as we downgraded banks and realized that there was some differences from that 94 analog, most notably the fact that the just magnitude of the yield curve inversion was the deepest inversion we'd had since the Volcker regime, which ultimately led to the demise of the savings and loan industry, which at the time was 80% of mortgage credit creation, the total supply of mortgage credit into the market. And so that similarity got us much more cautious on banks. And so we were a little mixed in our view through the market, but still thought there was a good chance we could wind up the year at 4,800. When we got to September and the Fed seemed to change the rules of the game somewhat, we became a bit more cautious. Our idea was that the Fed had, as opposed to just riding the disinflationary wave, now and we should have always detected this, but the Fed does worship at the idol of the Phillips curve, so to speak, right? And so this is kind of the dilemma we're in right now, and the reason why we think the market is going to struggle through at least the first quarter of the year, maybe into the first half of the year. We laid this out in a somewhat simplistic or catchy way to think about it in our latest note, and we called it quadrilemma. And the idea was there's 4 critical fours that you have to think about in order to get through this what I would consider to be difficult period. And so the idea here is that ultimately to disinvert the yield curve and open up the bank credit channel, which we think is so critical to being able to refinance this huge pipeline of multifamily real estate that's being developed. We have over 1 million units under construction that once they get finished, they will need to be refinanced into multi-sector loans. There's also $7 trillion of government debt that needs to be refinanced and another $2 trillion of new supply, because that's the underlying trend for the deficit and a range of small business related debt that needs to be done. There's a lot of high yield and even investment grade credit that needs to be rolled this year. So we think the Fed does need to cut to 4%, which is the market expectation roughly, looking at the Fed funds curve. If they don't cut to 4%, it's unlikely that the 10-year Treasury can stay below 4%. It's currently, a little bit above that. So in order, though, to get the Fed to cut to 4%, we do not think inflation is going to be enough. And we can come back and talk about that. We think that they'll likely need to see an unemployment rate above 4% and average hourly earnings, particularly the non-supervisory series, which is, production workers, has a much longer history, will have to go decidedly below 4%. So there's our quadrilemma, right? 4%. Fed needs to cut to 4 by the end of the year in order to keep the 10-year note yield below 4. And to get there, we need a over 4% unemployment rate and a under 4% core average hourly earnings growth. It's hard to imagine getting that scenario to unfold without calling into question 11 to 12% earnings growth this year. So we did have an earnings recession. For all that debate about whether we're going to have a recession or not, we did have a recession. In essence, we had a recession, 3 quarters of negative S&P 500 earnings growth. The corporate contribution to gross domestic income, which does a much better job capturing business cycles than gross domestic product does, that was negative for 3 quarters in a row. It lined up with gross or S&P 500 earnings, as you'd expect. That ended at mid-year and turned positive. So most investors are expecting a robust recovery in earnings. Well, in a softening nominal income growth environment, in an environment where average hourly earnings growth decelerates, and I could explain why I think that's likely to happen, why the unemployment rate is likely to go over 4, it's hard to imagine that we get this robust earnings growth. So, you put those things together and then add to that the inflation outlook. And this is critical because the Fed had this really strange forecast that they put forward in September that inflation was going to reaccelerate in the 4th quarter. That clearly didn't happen. But when you decompose inflation into what we can call Powellflation, right? This goes all the way back to his November of 22 inflation forecast, right, at the Brookings Institute, where he broke inflation into core goods, non-housing services, got sort of categorized as the super core, and then housing inflation. If you think about those 3 categories right now, and 6-month annualized inflation is all the rage, right? Every time Nick Timiraos, the Fed whisperer at the Fed or the Wall Street Journal, writes about this, he talks about 6-month annualized inflation. Well, right now, housing inflation is running over 5. It will continue to come down as we lap some very strong, 0.75% monthly increases for the next 3 months. So that'll put some downward pressure on core inflation through March. Core services, though, are running at 4%. Now, this number was never 2. It was more like 2.5, 2 3/4 for the 20 years prior to the pandemic. So it's not likely to go back. And you could see evidence of fiscal spending within inflation as well. The sole reason that inflation has come down is because core goods inflation is deflation again. It's falling at a 2.5% annualized rate. This is as deep as the decline that we got on an annualized basis in the early 2000s, shortly after China was admitted to the WTO. So we're getting a second wave of deflation coming out of China. Chinese import prices are falling at a 2.9% annualized rate. So we're getting the second wave deflationary shock through goods prices that seems highly unlikely to persist, even through this year, let alone through the business cycle as we restructure global supply chains. And we have problems in, now the Suez Canal. We've had all these labor supply shocks over time. And we're already seeing signs that global trade is accelerating. Asian exports are the leading edge of this. They've gone positive. So counting on goods price deflation to keep our inflation headed towards the Fed target, to me, seems like a fairly low probability outcome. So if you sort of put all that together and you think, okay, we've got, a Fed that wants to see or expects to see a deterioration in the labor market in order to cut enough to disinvert the curve. Can that happen with really robust earnings growth and inflation coming down towards target, where, because we're counting on goods prices to continue to fall at a 2.5% rate? Seems like a very low probability outcome. As a consequence, it seems more likely to me that the first part of the year is more difficult, that we give back a lot of the gains that we've had since late October through that bear steepening. We could talk more about the treasury market, term premiums, and where that market is likely to settle. I'm not all that optimistic about the back end of the treasury market. I do think if we can get through that point and have something of a growth scare, get the Fed to start aggressively cutting, I am optimistic and do have a fairly optimistic target for the end of the year for the S&P. 5,100 is what I penciled in early December. Could be a little better than that with the earlier expected Fed, pivot and giving up on their last rate hike. But we need to have a rough start of the year, in my estimation, to set us up for a better end of the year.
Yeah. But to your point, how can the Fed cut rates as soon as March, which is kind of what's being priced in the futures markets, if inflation is this persistent?
Well, I think they could, pat themselves on the back right now and say, hey, goods prices are coming down. We don't care where it comes from. Because quite frankly, inflation, and this is an important perspective, inflation below target or at target in the 2010s was entirely a function of zero goods inflation for nearly 20 years. Housing inflation ran at 3, non-housing services ran at 2.5, 2 3/4. The stuff that was domestically determined based on Fed policy never ran at 2. It ran closer to 3. It was this exogenous shock that was why the Fed was missing target, which is why I was so critical about all that extraordinary easing they did in the 2010s that really just caused malinvestment, capital misallocation, money flowing into buybacks instead of CapEx, all that stuff, because they were trying to correct a problem that had nothing to do with them and there was nothing they could do about. So they could pat themselves on the back and say, oh yeah, it's fine. We don't care where it comes from. We can do it. The problem though is it's very clear from the minutes last week that there are still a great number of FOMC participants that worship the Phillips curve idol, right? And believe, and it was in the minutes as well, specifically, we can't get non-housing services down to target without better labor market balance, right? So the way they would be able to cut in March, in my view, is if the unemployment rate goes above 4. Now, I know it was at 3.9 2 months ago and then dropped to 3.7. The first month it dropped to 3.7. Curiously, there was this very large increase in household survey employment and not as much of an increase in the supply of labor. The Fed's been saying, hey, we've got this big increase in participation, immigration's picked up. Well, the last 2 months, that argument's kind of come unglued a little bit because participation has fallen. And so we get this increase in household survey in November, and then we get a huge plunge in December. Last Friday's report was really curious. We had a 2 million drop in full-time employment in the latest number. So if you look at the Conference Board survey where they ask people, are jobs plentiful or jobs hard to get? The relationship between that survey and the household survey pre-pandemic was off the charts strong, like a 0.95 R squared. If you build a little model using that, you get a 4.2% unemployment rate. So ultimately, when you look through a whole range of indicators, the JOLT survey last month showed hiring slowing back to 2015 levels, quits rates back down towards lows. The work week is at the lowest level of the back half of last business cycle. All these things indicate the demand for labor has fallen a lot, and we're getting probably just some distortions in the data. Remember, we had negative revisions 11 of 12 months.
Yeah.
There is a good chance that we're going to get a big upside surprise in the next couple of months to that unemployment rate and get to 4.
Yeah.
The final point I'd make on wages, which would also, facilitate the Fed starting to cut rates as soon as March, would be that turnover in the labor market has collapsed. So when you look at hiring plus separations as a percent of the labor force, really what happened to wages, at least half of the big spike we had in wages that peaked in early 2022 was attributable to the greatest amount of churn we've ever had in the labor force, the great reallocation. Workers used the pandemic as an opportunity to go get a new job within industries or even change industries. And that caused a one-time labor shock, wage spike. But what that actually does is increases productivity as they get trained and they're settled into jobs they'd rather be in. That's now completely reversed. The so-called jobs finding rate hit its second lowest level in the history of the series going back to 1992 in the December report. Those things drive wages down. So it's likely that in the first quarter of the year, we're going to see the unemployment rate go up and average hourly earnings go down. This will get the Fed spooked about the employment part of their mandate and start the cutting cycle. So that's, to me, the hurdle we need to get over. However, if that happens, as I said, there's going to be a real gut check on the strength of the earnings recovery. So
yes,
that's why you sort of can't get there from here without some sort of a growth scare that causes, an issue for equities.
Yeah. Now, we'll get to equities in a minute, but the bond market, you would think, would probably react positively to the prospects of Fed rate cuts, as it did in November and December.
It did, except that the issue here still is we have not resolved the supply problem. And we had our second real warning sign that we have reached our fiscal limit. The first one came from January 4th of 2021, when the Republicans lost the Senate in the Georgia special elections. Excuse me. And maybe we should think of it that way.
Yeah.
Anyway, from that point on that January 4th through the signing of the American Recovery Plan, the $1.9 trillion stimulus. Remember, expectations at that point were no additional stimulus, and we wound up with $1.9 trillion. The 30-year real rate, or TIPS yield, which is the part of the curve least influenced by the Fed's balance sheet or the Fed's policy rate, that moved up 60 basis points in a matter of weeks. So that was a shock or warning sign that the Treasury was going to struggle to sell all this debt. Now, the Treasury then decided to drain their account at the Fed, cut issuance. You'll recall the big hullabaloo about Stan Druckenmiller saying that Janet Yellen should have extended duration. She didn't. It wasn't a question of her extending duration or not in 2021. She just stopped issuing, right? There was $1.7 trillion in their checking account. And they just cut issuance altogether. So that was our first warning sign. The second one came beginning in early August of last year, when the Treasury announced they were going to sell an additional $500 billion more of coupon securities in the second half of the year than the market was expecting, because the deficit was bigger than expected. So again, we had this vicious bear steepening. It moved a similar amount, 60 basis points, through the month of August. We then got a weak payroll report, and it looked like the Fed's September meeting would be fairly dovish. They would probably even eliminate the last rate hike from their forecast, but they didn't do that. They actually had a very hawkish forecast, exacerbated the move. Now 10-year or 30-year real rates are up 120 basis points. The term premium models, went from deeply negative to positive. And this only stopped when the Fed acknowledged, hey, we may have overdone it. They had what I called a policy put at that point, where they acknowledged, hey, we had a real tightening of financial conditions. The move of 10-year Treasury yields to 5% is doing our job for us. And then they confirmed they weren't going to hike anymore. That was the pause. And then, of course, in December, they announced, hey, the next move's a cut, essentially announced. And that whole process caused all the term premium to move back negative. But it doesn't resolve the fact that they still have 2 trillion more of supply, 7 trillion to roll. And with the yield curve deeply inverted, their decision to issue primarily in the belly of the curve, so 2 years to 7 years, that's the portion of the curve that the banking system plays a huge role in financing. So if you think about, I wrote back at the time, Treasury Secretary Yellen lost all her best customers, right? So the best customer for treasuries for the last 15 years has been the Fed.
Yeah.
Second best customer is the banking system. Banking system bought 1.8 trillion of treasuries in 2020 and 2021 when, the Fed was just flooding the system with liquidity, as was the Treasury by reducing issuance. And then the third best buyer were Asian central banks in particular. And we could see Chinese holdings are coming down, Japanese holdings are coming down, and those are unlikely to reverse because global trade has slowed a lot and it's not going to pick back up most likely. So with the curve deeply inverted, the banking system cannot buy 7-year treasuries or 10-year treasuries in any meaningful amounts because they fund it with deposits that cost over 5%. Now, it's not true for JP Morgan, but it's true for the baseline banks, the majority of banks in the system. So in order to get the banking system to help finance the federal government, the curve needs to disinvert. So back to our sort of trap. And here's the problem with Treasury. So at the end of the year, I would expect.
Sick of me yet? Become a premium subscriber and avoid all ads or interruptions. Other benefits as well. Visit contrarian.supercast.tech for more information.
At the end of the year, I would expect that the Fed will ultimately cut rates to 4%, but not without this deterioration in the labor market first. But I expect the curve to disinvert and 10-year treasuries to probably be more like 4.5% at the end of the year. So
okay,
counting on another big rally like we had from late October through the end of the year. Remember, part of that was positioning because we'd had this vicious bear steepening move, and so it reversed. But once we start settling into a higher trend inflation environment, roughly 3% or so, probably higher nominal growth, could be higher productivity. I mean, that's the other thing we haven't talked about. And the reason why ultimately I'm reasonably positive on the markets, even through stock market in particular through the cycle, is because I do think it will be a strong productivity cycle. It's another little bit of another story. I'm off on a tangent here. But I can't see how we continue to have negative term premiums in an environment where trend inflation runs higher. The Fed's not headed back towards zero, in my view, anytime in the foreseeable future. And it just doesn't make a lot of sense given the stock of debt that we have and the financing needs, even with a deal to level off spending like we had over the weekend. We still are going to run 2 trillion deficits as far as the eye can see. And that's the SIBO forecast, right? Congressional Budget Office. So.
Yeah. What about the QE and the Fed? The Fed is the biggest buyer of treasuries. And what about them coming back and doing that along with rate cuts? Is there any prospects of that, you think, this year?
Well, there was a really interesting development over the course of the weekend. I had foreshadowed this, I suppose, in my note this week by picking up in the FOMC minutes that there was a real discussion about tapering QT. And I've been watching the liquidity, the plumbing really closely. I learned more than I ever wanted to know about this when I was managing director at Lehman, and we learned about sieves back in 06 and all. But essentially, if you look at the liquidity in the system, there's two big sources of liquidity: bank reserves and the Fed's RRP program, which is where government money funds were parking their funds. When the debt ceiling deal got done in the summer, the Treasury began rebuilding their account at the Fed from 0 to 750 billion by issuing treasury bills. Now, when the Fed announced that they weren't, or hinted that they weren't going to be hiking anymore, money funds extended duration by, instead of just parking it in RRP, they bought 3-month bills and 6-month bills, which for their liquidity requirements, which is they're supposed to have 7-day duration on their securities, bills, even though they're 3 months or 6 months, count towards that requirement. So they extended duration. That RRP balance, which was $2.5 trillion, is down to some $700 billion. It's plunging. Bank reserves have remained stubbornly high. Initially, the Fed looked at this bank reserve number and said, oh, there's plenty of liquidity in the system. I think they've come to the same realization that I've came to, which is that banks are hoarding reserves, that the lowest comfortable level of reserves has gone up a lot. And I'll give people some long-term perspective on this, not to sound, like a Cassandra about it or anything else. But in 1937, Mariner Eccles, the chairman of the Fed, thought we have all these excess reserves in the banking system, so we can raise the reserve requirement. And that caused the recession within a depression because banks wanted those reserves. And so they cut loans. Well, right now we have a very similar situation. As I mentioned earlier, they have all these multifamily real estate projects that they funded the construction piece of that need to be refinanced, but also the capital requirements proposed by Vice Chair for Supervision Barr for both the big banks and every bank with over $100 billion in assets. The change in the Community Reinvestment Acts that Governor Bowman has argued is basically arguing are unconstitutional. It should take an act of Congress to do that. All these things mean that banks actually want to hold more reserves. And so they mentioned it in the minutes, and then Dallas Fed President Lori Logan, who of course used to be in charge of the SOMA portfolio at the New York Fed, gave a speech and said we may have to taper QT because we're getting worried about liquidity in the system starting to get tight. That's part of the reason why the market's rallying this morning, is this idea, okay, QT could end sooner than we expect. The problem with all that is if you read Logan's speech, you don't just look at the headline. She went on to argue that this big loosening of financial conditions that's occurred since late October is working against what they're trying to do and may cause a resurgence of inflation. So let's say we follow Logan's logic out and they taper QT, but don't cut rates. Well, now you're going to deepen that yield curve inversion further, make the situation worse for banks, make their ability to finance the government even more difficult, and cause a big problem. There could be an offset. The Treasury could decide in their next quarterly refunding, instead of issuing it in the belly and a greater amount of bills than is recommended by their borrowing advisory committee, people like BlackRock and all the private sector people that advise the Treasury, they could extend duration. That could cause the curve to steepen, but that also means 10-year yields and 30-year yields go up. And so, listen, we just have this mountain of debt. Ultimately, this is a very important political issue as well. And we take Fed independence, and I'm using quotation marks here, for granted, right? Since Volcker, the Fed has been reasonably independent from the federal government. The Fed was not created by the founding fathers. Hamilton might have wanted that, but that's not what we got, right? Jackson eliminated the second bank. It was created by an act of Congress. Bill Martin, the chairman of the Fed in the 60s, actually from 1951 through 1970, famous quote is, the Fed is independent within, not of the government. Ultimately, the Fed is responsible for helping the government sell this debt. And on the path that we're on, the Fed is going to need to coordinate with the federal government. And one highly probable election political outcome right now would likely lead to less Fed independence. Right?
How would that happen?
The front runner in the polls, expectations for the Senate would likely lead us to a Fed chair that is less independent than the current Fed chair. Now, Powell's term isn't due to 2026. President could make his life miserable. He could decide to walk away. Then we get an appointment of someone who is a little bit more Arthur Burns-like. And that could create, a longer-term inflationary risk as well. So just something to think about with respect to the outlook for 2024.
We hope you're enjoying this episode of the Contrarian Investor Podcast, where we give voice to those who challenge a prevailing narrative in global financial markets. Consider becoming a premium subscriber. For $9 a month or less, premium subscribers receive a number of benefits. Podcasts are posted immediately after they're recorded. Transcripts are made available within 24 hours. Premium subscribers get direct access to the host, and of course, there are no ads or interruptions. Visit contrarian.supercast.tech for more information.
By the way, you don't need the .tech suffix to get to that website. .com will do the trick. And we also have a Substack where you can sign up for the same prices, same benefits, same details. contrarianpod.substack.com. So if you already have a Substack account and use it, or have the app and use that, that's probably the best way to go. So contrarian.supercast.com or contrarianpod.substack.com. Whole bunch of benefits, including, of course, getting this episode up to a week early without ads or annoying announcements. And you also get the daily Contrarian briefing and podcast that is released every market day morning at 7 a.m. This is a contrarian take on the events of the day ahead and what is likely to move markets, such as economic data releases, earnings, and other things. It is really good, and that is completely unbiased, of course. So check that out, contrarianpod.substack.com or contrarian.supercast.tech. Now on with the show. What about this debt ceiling stuff? And you talked about this last year also, how this was a kind of an overhang. How big of a concern is that? What do you think are they just going to kick the can down the road again?
A year ago, for the first 6 months of the year, counterintuitively, I was calling the debt ceiling a net positive. Whereas everybody else was talking about this, what if they shut down the government and this is the negative and political uncertainty. I was saying, no, this is a net positive. And the reason it was a net positive is because the Treasury couldn't issue.
Yeah.
Right? And so the fact that they couldn't issue created more liquidity in the system and was a contributing factor to the favorable environment for equities in the first half of the year, even with the bank failures. Well, we're in the opposite situation now. The debt ceiling's been suspended until 2025, so they can issue as much as they need to. So now, without a debt ceiling, it's actually a net negative because if they need the liquidity to fund the government, they can sell whatever they need to sell. So,
what about the short end of the curve? I mean, this is something also that, how do you leave? Where do you see all that?
Well, I'm favorably disposed towards twos for sure. I've been very bullish twos for quite some time because I've seen this underlying weakness in the labor market. And I should just make an additional point about the labor market. I mentioned the 11 of 12 negative revisions. Remember how the labor market gains are estimated by the Bureau of Labor Statistics. There's one giant model that estimates small businesses. It's the birth-death model. And the birth-death model uses data from the IRS to estimate how many small businesses there are. But the lag in the data they get for how many businesses just pack it in, deaths, is really, really delayed. And it looks like they're vastly overestimating small business employment, which is partially why we keep getting these negative revisions. And, when you look a little more deeply into that data, you probably come to a similar conclusion to me that they're overestimating employment probably last year by 1.3 to 1.5 million jobs. So within that context, we are in a weaker labor market spot, in which case I do think they could very easily start in March. And in that environment, you really want to be in the 2-year part of the curve. But again, until twos are low enough that twos tens curve disinverts and flips positive, it's really hard to envision that the demand for the back end of the Treasury market is going to be all that robust. We had the household sector aggressively participate and hedge funds participate in it in the rally in the fourth quarter. But underlying demand is still reasonably sketchy.
Yeah, we're about 30 plus basis points, I think, from the uninversion of the 210s. What is it, 4.35 for the 2 and 4.03 something for the...
Correct. Twos, tens are 35 inverted, but I would keep my eye. Ultimately, what really matters for the banking system is the 3-month bill, 10-year note, because that's something of a proxy for what banks do, right? I mean, they pay the front end short-term deposit rate. They have to compete with the Fed's RRP and, to get deposits. Again, maybe JP Morgan continue to pay you 0 because you're worried about they get a safety premium. But for the baseline banks, they need to pay a market deposit rate. So that's closer to the bill rate. And that's inverted by 135 basis points.
Oh, it's still that much. Okay.
So it's massive. And I just want to make this point one more time, if I may, because I think it's crucial. There's only been 4 occasions in post-World War II history where we had curve inversions this deep. It's often said the yield curve forecasts recessions. Well, it can cause them also. So in 1973, we had a curve inversion to the tune of about 120 basis points on the 3-month bill, 10-year note. We had it in late 79, late 80, and then this one. And the 79-80 is really one episode. Volcker eased after Carter's credit controls in early 1980 because he crashed the economy. ISM fell from 50 to 29 in 3 months. Then he had to reverse the whole thing. That's really one episode. And that one episode caused as I said, savings and loan industry to collapse ultimately, although the government did everything they could to keep them alive for 10 years, the Bailey Building and Loan, so on and so forth. But the 73, 75 recession was very deep as well. We've never had anything like that except those few occasions. And so, we had a very steep or sharp flattening of the yield curve during the aggressive rate hike cycle in from Feb 94 to 95. But that starting point was 100 plus 180 for twos, tens, and it went to 0. Well, a 0 Treasury curve, the banking system can live with for a time.
Yeah.
But 135 basis points inverted, that's a problem.
And how long were these
banks
inversions?
With no alternative but to shrink.
Yeah. How long were these previous inversions? Were they as long as this one? Because this one feels like it's gone on for a while.
Well, that 79-80 episode was fairly lengthy. 73, not as much. This was a pretty deep inversion. Now, the banking system was relatively de-risked in the sense that if you look at the loan to deposit ratio, there was, and I was reasonably optimistic, full disclosure, about the banking system at this point a year ago because of that lack of credit risk. And I was underestimating the interest rate risk in the system, right? I knew that they had accumulated all these treasuries and I knew it was a problem, but I thought, if the Fed doesn't keep tightening, then the problem doesn't get acute enough. There were some unique things that happened along the way, but we won't dig into those details too much. I already went deep into the bank plumbing stuff. But anyway, the fact that they are de-risked, meaning very low loan to deposit ratios, there's not a ton of credit risk in the banking system. Yeah, I've mentioned multifamily real estate. There's some commercial real estate, but they are not loaded to the gills with credit risk to that household sector or non-financial corporate sector. And by the way, both those sectors themselves are relatively de-risked. All of the risk, the excessive leverage risk in the US system resides in the federal government right now.
Yeah.
Which
right.
makes it a very, sort of unique cycle, not unlike what happened after World War II.
Could we see further downgrades of U.S. debt?
Sure.
And that could be a catalyst for selling in bond markets, as it has.
Sure.
Been,
not to get too political about all this, but you'd have to assume at this point that the two leading candidates to get the nomination and run for president, neither one is likely to be a catalyst for a structural path change for our debt.
Yeah. Wow. Okay. All right. Where does that leave stocks, equities, just sectors? Speaking about sectors, you touched on the banking, the financial sector, maybe. Sounds like that could be okay if I'm extrapolating from what you're saying. But yeah, where else?
Well, I'm underweight banks and I'm underweight small caps right now because of the
wrong.
quadrilemma dynamic. This idea that we probably need to have a growth scare, a deterioration in the labor market in order to get the Fed to start the process. Once the Fed starts the process, the tightening or easing process, then I could see my way clear to being long small caps and long banks. But until we get to that point, I would continue to be underweight both of those sectors. I mentioned productivity a little bit earlier. Last cycle, we had one of the weakest cycles for capital investment that we've had since World War II. The only weaker one was the 58-60 cycle, which was very short. Capital investment has a very favorable outlook through this business cycle, although right now, business confidence has come down a lot, capital spending plans have eased. So first half of the year will probably be flat, but it's likely we'll have a strong CapEx cycle. It's also likely we'll have decent labor productivity if this current funk that we're in, which is payback from the great reallocation, starts to improve and labor market churn and dynamism turnover start picking back up. That was a trend through last cycle. We went from all-time lows of churn to all-time high. But most importantly, technology innovation adoption. So we spent a decade building out the cloud, digitization. Those benefits should start to accrue to the users of that technology, not just the consumers of that technology. We saw, cloud investment growth slow in recent years at Amazon, Microsoft, Google, before it reaccelerated as the generative AI, boom came along. I'm going to be looking very closely for evidence of productivity accruing to industrial companies, healthcare companies, finance companies. We don't need a bank branch anchoring every strip mall in this country, right? Healthcare has been the biggest drag on productivity in this country for 40 years. Telemedicine, all sorts of, just really using technology to deliver services could be a real boom through the cycle. So one of the ways I'm trying to watch that is taking sales per employee for the various S&P 500 sectors. I'm deflating it using CPI, comparing that to profit margins and looking for evidence of productivity picking up. The broader productivity story was from 2011 through 2017. And you have to be careful looking at productivity in the early stages of a business cycle. For example, we had a surge in the back half of last year as employment growth slowed and we got to the other side of this great reallocation. It's unclear whether that's a persistent trend or not. But we did see last cycle very slow productivity from 2011 to 2017, less than 1% growth per year. And the post-World War II average is over 2. But then in 18 and 19, it really accelerated. And it was coming primarily through the service sector. Manufacturing was in recession as a consequence of the trade war. But you could see it. And an easy to understand example is Starbucks, right? Starbucks comp store sales had stalled out in the 2010s until they invested a bunch of money in their app and got a third of their customers to skip the line, come in and grab their coffee and solve their queuing problem, right? So the pandemic accelerated that process, in my view, using technology in simple areas like restaurants, right? Come in and order on iPads and save the waiters and waitresses time. I think we'll see that process accelerate through this business cycle. A stronger productivity cycle means profit margins are not mean reverting. We had a positive earnings shock. Earnings are nominal, they're not real. So this is where a bunch of strategists a year ago got it wrong, thinking earnings are going back to 180. And I said, no, they're not. If we have an earnings recession, it'll be shallow, because that's what happens in higher inflationary recessions, right? 69, 70, 73, 75, 80, 81, 82. Earnings declines were pretty shallow. So we had a 5-6% earnings recession. We're coming out of that. Productivity should be strong. I do think there's a prospect for reasonably robust earnings growth through this business cycle. I think it could be very much like the 60s, where valuations were high, but earnings growth accelerated from roughly 9% outside of recessions in the 50s to more like 15 through the first 8 years of the 60s. But bond returns were negative because inflation was trending higher through that cycle. So it's sort of I think we can get to that point if we get that deterioration in the labor market, Fed reacts to it, disinverts the curve, then we could be in a fairly strong productivity environment that is, good for corporate earnings. Still, the bond market valuation is in the wrong spot. And I think I wrote this in 2020 that the 39-year bond bull market was over, and we are in a new cycle, and yields are going to grind higher over time. They were in the wrong place in part because of the Fed and Asian central banks engaged in mercantilist policies back in the 2000s. So I'm not optimistic really that bond returns will be all that robust, and negative term premium, to me, treasuries do not look attractive whatsoever from a longer strategic perspective. But the stock market could get into a 60s sweet spot where we have strong investment cycle, strong productivity, and in which case, I've continued to like industrials, energy, materials. Those are the cyclical sectors I like right now. I think there might be a tactical spot to get underweight tech, but I'm market weight tech. I essentially consider being market weight tech in the US already a big enough bet. It's, tech and tech related. So comm services and discretionary, which is kind of dominated by tech companies. If you are cap weighted, those are so big that being overweight those sectors is almost reckless, right? So sort of market weight those sectors, overweight industrials, materials, and energy, underweight banks, and I'm overweight healthcare, although I tried to get overweight that last year and it didn't work out. And I still think that we're in the early stages of healthcare going through something of a technology revolution that will make the sector, finally stop being such a big drag on productivity in this country. And then staples, utilities, those sectors, bond proxies, REITs, I want nothing to do with them.
Fair enough. The healthcare, though, has traditionally been more of a defensive sector, though.
It sort of borders on the edge of that. It's become a little bit more cyclical. A former colleague of mine at Barclays was really good about this, did some great work. His name is Josh Raskin. He's now an independent research provider like me.
Should have him on the show.
But Josh talked a lot about the consumerization of healthcare. With the increase in these deductible plans, it's made the consumer much more sensitive to spending patterns, and it's made the sector a bit more cyclical than it used to be. When most of insurance was achieved through your company and the deductibles were small, you weren't particularly sensitive to it, except that if you got laid off, but then you got Medicaid, excuse me. It's a little more cyclical than it used to be, but you're right. I mean, I'm not really long healthcare because of cyclical business cycle reasons. My idea is just that, the pandemic may have been a shock that causes healthcare providers to finally start integrating technology into the delivery of healthcare services.
Yeah, so
that'd be companies
Yeah, right. Well, they have their own things.
There's still rent seekers. Yeah. I mean,
Yeah, but health tech sounds like it could be, that'll be positive then. Yeah. Very good. All right. That's a nice way to wrap it up. Barry Knapp, thank you for rejoining the podcast. In closing, maybe you can tell our listeners how they can find out more about you, about your research. I will put this all in the show notes, of course.
Awesome. So I started Ironsides Macroeconomics in 2018 after 25 years at Lehman Barclays, a couple of years at BlackRock on my sabbatical at the buy side, and then a 18-month stint at Guggenheim Securities. I've tried to make the product approachable, although it's, I've spent my career talking to institutional investors, but I've tried to make it a little bit more approachable. The product is housed on Substack, so you can go to ironsidesmacro.substack.com. I've created a subscription-based product for sophisticated individual investors, wealth advisors, money managers, so that you could subscribe to the product. I also have an institutional client base that I interact with, more frequently, and I have a relationship with macro risk advisors for clients that like to pay for research the old-fashioned way, which is with trading commissions. And we create some additional products, some videos with macro risk advisors, Dean Kernett's firm. Dean was a colleague of mine in equity derivatives back at Lehman Brothers. And so there's a pretty good derivative tilt to what we do there as well for those that are interested in options and and the like. So yeah, that's it. But I'd suggest everyone go to ironsidesmacro.substack.com. We produce that fairly lengthy 2,500 plus word with 8 to 10 charts weekly that comes out every Saturday morning. There's some other notes we'll put out, payroll previews, for example. There's an audio summary of the weekly podcast to try and make it even a little bit more approachable. And we'd love to have you consider. If anyone wants a trial, send me an email. I'm happy to do that.
Cool. Yeah. And then you are on the social media too.
Twitter, LinkedIn, primarily.
Yeah,
yes.
We got those. Cool. Awesome. I will put that all in the show notes. Thank you, Barry, for coming on. Thank you all for listening. We'll be back here again, probably in a couple of weeks. Speak then. Bye.
Thank you for listening to the Contrarian Investor Podcast. We hope you enjoyed this episode. To subscribe to this podcast, simply open your favorite podcast software and search for Contrarian Investor. Follow us on social media by searching for Contrarian Investor on Twitter and Instagram. Send us your thoughts on feedback@contrarianpod.com. We look forward to speaking to you again next time.